So this is one of the more famous graphs that's been around for half a century or thereabouts. That really is a picture's worth 1,000 words. This graph is worth 10,000 words, because this basically says what diversification is doing for you. There are some assumptions behind this graph, and one of the assumptions is that the non-systematic risk is uncorrelated between firms. But basically what we're doing here is we're starting off down here with a single firm, and we're calculating the risk. We do that with another single firm, and we calculate the risk. And we do that with another one, and we kind of come up with an average of the risk. And that happens to be up here at 49.2% standard deviation. Okay. Now we do the same thing, except with a portfolio now of two firms. So we're going to randomly draw two firms, calculate the standard deviation of their returns, and record that. Do that again, do it again, another, 100,000 times, however many firms it takes. And we're going to calculate that risk, and we're going to see that that's a little bit lower. And we do that with 3, 4, 5, and up here we're at 10 firms in each portfolio. So we randomly draw 10 firms, put them in a portfolio, look at the standard deviation of their returns, and it turns out that it's 23.9%. So a little less than half of the standard deviation of a single firm in a portfolio by itself. So we've reduced the amount of risk by adding securities to our portfolio. Now, what you do also see is that while that line is going downwards, it's also, the slope is changing, and it's asymptotically approaching some horizontal out here. And the authors show this to be 19.2%. So another, almost 5% down from having 10 firms. And now that the bulk of that comes somewhere out here in the 30, 40, 50 firms in a portfolio. Now, mind you, these are totally randomly drawn firms, right? We're not segmenting based on sector or industry. We've just got every single firm, every single asset, in fact. We randomly draw, we get 50 of them in a portfolio, and we calculate their standard deviation of returns. And what we find is that whether we have 50 or whether we have 1,000, as we see over here, that standard deviation of returns really is pretty much the same between those two types of portfolios. And even if we go out and we have 10,000 out here, standard deviation of returns seems to be the same. So it's this portion up here that's kind of this mauve purplish color there. That portion is what we call diversifiable risk, because by adding securities to our portfolio, at random, we can get rid of that risk. Yet, this kind of tan-colored area down here is non-diversifiable risk. In other words, even if we have 10,000 securities in our portfolio, if we have the entire market in our portfolio, we don't get rid of that risk. You can also think of that as business risk. That's the risk that we are taking on, that we want to take on, right? The diversifiable risk is risk that we can easily get rid of. This is a key behind the asset pricing model called CAPM, right? The key is that this type of risk, this tan area, that risk, that's the only risk that we're actually getting paid to take on. Should we choose to have a portfolio of just 10 companies or just 5 companies, we're going to actually have a portfolio that has more risk. It's going to register right up here instead of down here. We're taking on extra risk for which there's absolutely no return. There's zero reward for taking on this risk up here. So why would we ever do that? So this is the idea behind having a highly diversified portfolio. So if you're an active stock manager and you only have 10 securities that you found that you think are going to outperform, you don't have a very diversified portfolio. Now, there's some really slick techniques to combine those 10 firms with a market portfolio to maximize your reward for the amount of risk you're taking. So there are ways around this. There are some little tricks that we can use that allow us to take advantage of the market, the widely diversified market, even if we have only a few mispriced securities that we're trying to use in our active portfolio. But recognize that if we just hold that active portfolio with 10 securities in it, we're taking on more risk for no reason. Okay, so this graph really pretty much says it all. Another thing to keep in mind here is that the securities. Well, let me back up here. This risk is also called idiosyncratic risk. That means it's unique to the company, right? Or also firm unique risk is another term that gets used for that. Well, that risk, we assume that it's uncorrelated with other companies. And that's why this idea of drawing these firms at random is so important, because then we have a fairly good chance that diversifiable risk is not correlated with the other companies in our portfolio. And basically, those risks cancel each other out. I'm not going to spend a ton of time on this idea of the fallacy of time diversification. It's not really a fallacy. It's a fact. What is a fallacy is the way it's usually described by those that are not quite fully knowledgeable about the asset pricing models behind this and some of the issues related to them. So this idea that for somebody like myself, much closer to retirement, that I can't take as much risk than you all who have decades before you retire. The idea, some people will state the idea as, well, because you have 30 or 40 years, the standard deviation of returns is going to converge towards zero. And therefore, that's why you can take on more risk. And actually, that's the wrong argument. It's the right idea, but it's the wrong argument. And this table right here tells it all to us. If we look at the geometric returns by investment holding period, all right, so we start off with a single year, and we see that the average return is about 12%, and the standard deviation of that return is just a shade under 20%, right? Now, if we extend our holding period from 1 year out to 10 years, what we find is that, the geometric return drops down a little bit. And mind you, this is on an annual basis. So we're just having a holding period of 10 years, but our numbers are still on an annual basis. So the return drops from almost 12% down to 10.3%, 10 and a quarter. So it drops by 1 3/4%. But look at what happens to this standard deviation of returns here. Boy, it's a pretty healthy drop from nearly 20% down to 5.6, 5.5%. Yeah, we lost 3/4 of the risk in the returns by having holding periods that are 10 times longer. And as we extend that 20 years out here, we lose a little bit in the return, but then our standard deviation still drops. And in fact, if we get out to 40 years, our returns drop by just a little tiny bit, 9.3% now. But look at what happens to the standard deviation of returns. For all intents and purposes, it's zero. And that's the argument that people will use to say, hey, this is why you all can take on greater risk. And somebody like myself should probably have a more conservative portfolio. Now, there's a little bit of a misstep there even, because even if I retire in 2 years, I'm hoping that I'll be around for another 25 or so-ish years. So really, I should still be taking a fairly risky position because I don't want to run out of money. So even that is a little bit of a fallacy. But that's the argument that gets used. Well, here's the problem. Let's go down and look at this table down here. Instead of looking at the holding period of returns, let's look at the wealth over various holding periods. Because what really matters to us is not the returns. It matters as to how much money we're going to have at the end of the game. How much will you have in retirement? So for 1 year, we start off and our wealth is relatively low because we've only had 1 year. So our average wealth is $1,000 and we have a standard deviation of wealth of about $200, a little over 1,000 actually. We go up to that 10-year mark and we've got $3,000 of wealth, but so has the standard deviation gone up by quite a lot actually. 1390. So it's getting up there. Let's go 20 years. We've got much greater wealth, 7,500. But look at that standard deviation of wealth, 4,600 almost. Let's go all the way out to 40 years. We've got quite a bit more wealth on average. But look at that standard deviation. It stayed up there. It hasn't decreased. And I don't care what the returns are doing, but if my wealth has that much volatility in it, that's not good. And if you remember back to the very first day, there was a spreadsheet that I showed you about, who wants to retire with $1 million. And, we ran various scenarios. I think it was over a 35-year window. And do you remember what happened to those values? There were some outcomes where instead of $1 million, we had, 600,000 or 700,000. And then there were other scenarios, same 35-year period, same distribution of returns, but we just had a different 35 draws out of that distribution. And there were other outcomes where we had 2.5 million instead of just $1 million. Right? That's what we're seeing here in this second table. That spreadsheet is basically what's being captured in this second table. And that's what matters to us. So here's why, though, you can still take on that risk at your age and be okay. The reason is not because returns have almost a zero standard deviation over long holding periods. The reason is that you have an opportunity to make up for that. Let's see, where is that slide? Yeah, here we go. So it's not because of that standard deviation of returns. It's because when you're younger, if you have a steep decline in the value of your portfolio, you've got some time to do something. You might have another 20 years of earnings that you can plow into the market, and instead of putting in 15%, you put in 20 just to make up for it. But at least you have time. You have a choice. You could even take on slightly higher risk, right? So, somebody in my position where my earning stream is about to get chopped off, and I'm starting to use my assets that I've accumulated, all of a sudden there, if I get a major hit, boy, I'm maybe not retiring, right? Or if I do, I'm retiring at a much lesser level. And actually, that's what this graph is all about, is kind of showing us that variation. And here we're looking at 40 years to retirement, and the idea that based upon how the market has behaved over the last century or so, we could have anywhere from 170-ish thousand on down to a much lower level, considerably lower level. They kind of put this in the framework of Rowboat City versus Rah-Rah Yacht and French Riviera up here. Definitely rather be up in this category than down here, for sure. But you get the idea. Again, this is showing you the same thing as that spreadsheet showed, as we saw in the tables. So this idea of being able to take on more risk because you are younger and you have more time, and it's not because of those returns, it's because your variation in your overall wealth is still maintains the same, if not even maybe a bit worse as you extend the holding period. So it's all about being able to make some adjustments. All right. Let's see. So we get to correlations. Correlations are, again, really, really, really important here. And again, this is why diversification helps us. If everything has a correlation of 1, in other words, they all move together, then the idea of having more securities in a portfolio to diversify is pointless. So it's all about correlation. It's all about how assets move relative to one another. The nice thing about correlation is that it's a bounded measure. By bounded, what I mean is that it doesn't go below -1 and it doesn't go above +1. So +1 is perfectly positively correlated. -1 is perfectly negatively correlated. And at 0, there is 0 correlation. There is no relation between two variables. And the other thing to think about here when you're thinking about correlation, the problem is that it's pairwise. We only have measures that we can compare 2 things. So if we've got a portfolio of 10 things, we have to have correlations, many correlations to compare all of them, because we're just doing it on a pairwise basis. By the way, I assume that you probably all know this, but just in case it's a little foggy, we can go between. We don't ever actually calculate correlation directly. Correlation between, let's call it A and B, like they have here, is actually the covariance between A and B. So that's a sigma divided by the standard deviation of A times the standard deviation of B. So this is, if we look at covariance between A and B, actually, I should do it this way. And that's a negative infinity. Boy, I write terribly. So in other words, covariance of two pairs of variables, that can range between negative infinity and positive infinity. So we can still tell whether they're positively or negatively related to one another, but because they have such a wide range, we really can't compare that pair against another pair. So what we'd really like to be able to do is compare the correlation between A and B with, say, the correlation between C and D. But if we're looking at the covariance of A and B, and comparing it to the covariance of C and B, that really doesn't tell us anything because we don't know how much each of these series, each of these pairs move. If we scale it by the standard deviation of each item in the pair, then we get this nice contained thing called correlation that falls between -1 and +1. And then if we know the correlation of A and B, and we know the correlation of C and D, oops, sorry, that should be a D, then we're okay. We can make some statements about A and B are more positively correlated than C and D, or vice versa. But if we just know the covariance, we can't say that. So correlation is a very handy measure, but recognize that we don't calculate it directly. It actually comes out of this. So we're just scaling that covariance. And as far as what is a positive correlation, obviously this is our positive correlation. When one thing goes up, the other thing goes up. I always like to think about it, if I know the direction of movement of the one thing and I have a positive correlation, I can tell you that the direction of the other thing is going to be in the same direction, and vice versa. Negative correlation, if I know the direction of one thing, I know that the other part is going to be in the opposite direction. So that's this graph right here. This one over here on the far right is a representation of zero correlation, but I actually have a cleaner version of that for you. Zero correlation is easy because if one series is invariant, doesn't change, and the other series is moving around, not like that, but you get the idea. If I know the level of the first thing, let's call this A and let's call this B. If I know the level of A, can I use that to predict which direction B is going? No, of course not, because A isn't moving. So that's also a zero correlation. In other words, I can't, if I know which direction one series is going, I have no clue how to predict which direction the other series is going. Now, if we start applying this to two securities, we've got stock A and stock B. We've got some returns, and we've calculated an average return and a standard deviation for each of these guys. And then we put together a portfolio, and that portfolio is actually looks like it's 50% A, 50% B. The way I can tell that is that the return on a portfolio is the market value weighted return of the individual securities. So B has a return of 15%, A has a return of 10% in this year. Well, and I see that the portfolio is 12.5, so I know I've got a 50-50 blend. So if I do that for each year, 50-50 of each of these, and then I recalculate my average return and my standard deviation returns, I see something really good here. My average return falls in between the two, but what really is drawing my attention is what's happened to the standard deviation of returns here. It's gone way down. And if I look at it in a graphical sense, this is what we get. So here is A graphed out. Here is B. Notice that the bad year for A is 2017. For B, it's 2016. And so they kind of cancel each other out. And when we put the two together in a 50-50 portfolio, we end up with no negative years, but it also kind of equalizes some of those peaks, right? So we don't have that really high peak here or this one here, but we have a nice stable return. You know, that 10%. That's what Bernie Madoff was promising. 10% every year. Hey. That's why people loved Bernie Madoff until they realized it was a Ponzi scheme. But this is how diversification is supposed to work. When it comes to how do we calculate these things, that's where it gets a little uglier. Now, we've looked at how to calculate the standard deviation of a portfolio when we knew the state returns and we knew the probability of each state. Now, in this version of the formula, we're assuming we don't know the state returns, which is actually more realistic, right? Who's going to know the state return? How do I even know how many states are out there in the next year? I have no clue. Could be hundreds, could be thousands of possible states. I don't know what the probabilities of them are. I don't know what the returns are going to be on them. But I can give you kind of a shot in the dark using historical numbers and a guesstimate about what's happening in the future to get you some general sense of where this security is. So if I have a standard deviation or a variance on a security A, and I've got A as well as B, and I know the variance of B, and I also know the covariance between A and B, I can actually calculate the variance of the portfolio and take the square root of that, and that gives me the standard deviation of the portfolio. So here's the formula. Now, unlike the expected return on a portfolio, which is simply the market value weighted sum of the expected returns on the individual securities, this one is a little uglier because the x's, XA is the weight on A. And that's given in a market value weighted sense. So think of it as a percent of our portfolio that's in A. So we've got X% in X sub A percent in A, and we have X sub B percent in B. And they add to 100% in this case. So we just have two securities in our portfolio. Now, we've got three terms here, though. We've got this, we've got that weight times the variance of A. And then we've got a second term, which is the weight of B. And by the way, we're doing this little squared thing. There's really not a lot of intuition there, but that's how the math works out, times the variance of B's returns. And then this is the term where the magic really happens right here, this third term. And in fact, what I would argue with you to do is that rather than look at this version of it, let's look at the next line down, which is exactly the same. If you remember, I said correlation of A and B is equal to the covariance between A and B divided by the standard deviation of A and the standard deviation of B, right? So if I do this, change the math around here, the covariance of AB is equal to the correlation of A and B times the standard deviation of A times the standard deviation of B. If I take this and I plug that in for the covariance, what I have then is this second line down here. And the second line, again, the intuition is just a little cleaner here for us to talk about. So let's think about this one. We still have these first two terms. Those don't change at all. By the way, this 2, that's a constant. We're going to have that 2 in there no matter how many times, no matter how many securities we have. Each of these interaction terms is what I call them. Each of those has a 2. That's just a constant. And then we multiply by the weight of A, the weight of B, the standard deviation of A, the standard deviation of B. Now, think about this a second. We've got an x squared term, that's positive. We have a variance term, that's always positive. So that means, I'm going to clear this mess out so I can, so that means that this entire term is positive. We have an x squared here and a variance here, so those are always positive. And this item is positive. We're assuming that we're not shorting, so all our positions are long. So this is positive. XB is positive. Standard deviation, because variance is positive, the square root of variance is always going to be positive. So that's positive, and that's positive. So right now, nothing in particular magic until we get to correlation. Remember, correlation is bounded by -1 and +1. So correlation can either be positive or it could be 0. Oops. Could be 0. If it's 0, this whole term just goes away. So our variance on our portfolio is simply the sum of these first two terms. If it's negative, like a -1, get rid of the 0. If it's -1, this term actually reduces the correlation of our portfolio. And if it's a large negative value, it reduces it towards 0. So it kind of cancels out some of this and some of this. So this is why we're looking for those negatively correlated assets. Whatever our portfolio is, if we can find an asset that has a negative correlation with that portfolio, buy that sucker. Because that'll reduce your overall portfolio variance and, generally speaking, hold your return probably not that far from where it is, yet you're going to be able to drop that standard deviation of your portfolio. All right, so this formula, like I say, I'm not going to go into where it's derived from. I don't think that's very helpful to you all at this point, learning where that comes from. If you'll just accept that this is it, then it's the intuition in this formula that I think is important for you to understand. Questions so far? I've been throwing a lot out at you, but...
Yeah, so when we're selecting securities for a portfolio, are we trying to get as close to a correlation as close to -1, or is it just 0?
Yeah, well, it definitely, I'd go for the -1 if you can find them. Those are like hen's teeth, though. They're very rare animals. You're lucky if you can find something that is positively correlated, but well less than 1. And even that, I'll take, right? 0 would be great. Negative would be even better, but hey, I'll take positive 0.3 if I can find it. So yeah, those the problem with those negatively correlated assets, they get bid up by quite a bit because everybody is looking for that because that lowers your risk of your portfolio. Yeah, does that help, Reed?
Yeah, thank you.
Sure. Any other questions? Yeah, this is, I left this slide in simply because there's, actually when I was a doctoral student at Arizona, my dissertation chair and mentor and friend and co-author after a while, he was doing some expert witnessing for a case, I think it was Prudential. And the case really was about where the investors put into a proper and safe investment. I think these were retirees, if I remember correctly. And if you looked at it in a portfolio sense, they were in a very safe investment. But if you took each individual asset out and you looked at it by itself, you go, whoa, those are really risky assets. Why are you putting retirees into these risky securities? And the answer is that, it's all about the portfolio. That's a tough argument to make to a judge and a jury who are very unsophisticated and very financially illiterate. That's a tough argument to make. That they look at one asset by itself and they go, wow, that's risky. But yeah, I'm combining it with these other assets that have low correlations. And look, the portfolio. No, I don't care about the portfolio. You really, did a bad thing for these investors. No, I didn't. I actually helped them. If I put you in a really conservative investment, you don't get the return that you need. So, if we look at, I could be super safe and put you 100% into bonds. You could get a 6% return, and you'd have a 10% standard deviation. But actually, look at this. I could actually get you a lower standard deviation and a higher return by adding some stocks to that. So the conservative strategy is not always the smart strategy to take. You have to look at the portfolio effect. And as I said, it's a difficult thing to argue, especially if you're in a court of law and you're talking to lay people about this. How do you explain that, gee, it's because these things are put together in a single package that they're actually safe and safer and better return and safer than the one thing by itself, even though that looks like it has little risk. So here we are kind of getting towards what I showed you at the end of class last week, this mean variance setting, right? So mean variance, mean standard deviation, same thing. So here's our expected return on the y. We have a standard deviation of returns on the x-axis. And if we plot our bond portfolio and our stock portfolio, and then some combination of more bonds and some stock, a little more stock and a little less bonds, and so forth, we can plot this frontier, and then we also know that if we take a vertical line and we start shifting it to the right, where that vertical line first touches, right there, we have a special name for that portfolio. That is called the minimum variance portfolio. In fact, there's a formula that is in Chapter 11 that tells you how to calculate how much bond, how much stock creates the minimum variance portfolio. And that portfolio is important because that's the beginning of our Markowitz efficient frontier. The rest of this down here is an inefficient frontier. And it's inefficient because it's dominated. If I wanted to have this amount of risk, well, I could have this portfolio right here, right? Or I could keep my risk constant and I could get a whole heck of a lot more return by going up to this portfolio up here. So all of these portfolios below the minimum variance portfolio are what we call dominated, first order dominated, by another portfolio up there on the blue line. First order because just by looking at the mean, we know that we're better off. Hold the variance or the standard deviation constant, and we're still better off because the mean is higher. We get a higher return, and we can hold that mean. Now, in some positions, we can actually reduce the risk. We could reduce the standard deviation and still increase the average return. But at very worst, we can we can increase the return and maintain the same risk. Nick, you had a question? Oh, maybe not. All right.
I have
Um,
a question, Professor.
oh, yeah, go ahead, Vince.
So, like, when I personally think about diversification in a portfolio, I don't think about core. This might just because the way I've been taught, but I think more of like I look at a portfolio. Let's say someone's 60 years old. I'm going to take 100 and subtract it by 60 and say, okay, so they should be
40%
40% equity,
equities. Yeah.
60% fixed income.
Mm-hmm.
And I feel like a lot of this class is centered around equity, but we don't talk about that fixed asset portion, which is huge when you're talking about a portfolio,
It
especially when you're
is.
talking about someone who's about to retire.
It is. You're absolutely right. First thing, that rule of thumb dates way back. And now the average lifespan of people who, if they retire at 65, that 40% equity, not going to cut it. They're going to outlive their money. That's one of the worst things you can do. So that number is a really low mark because hey, you retire at 65, you might live another 20 years. If you're just 40%, you're not drawing much. You're not able to draw much out of that portfolio and still maintain, um, enough money to get you through that next 2 decades, especially if there's a significant downturn in the market. So that part is a little bit. Most people will shift that around a little bit and maybe crank it up by, from 40 to 50 or 60 even. The other part of it, no, you're absolutely right. That I mean, the securities available to us as the market portfolio are really all of the securities in the world. So we're not only are we talking stocks and bonds, but we're talking money market instruments, we're talking real estate, we're talking currency, we're talking commodities. All of that actually goes into the market portfolio. So we really should have exposure to all of that. Now, I'll grant you that the equities actually capture a fair amount of that because companies own real estate, companies own commodities, or they have, energy company, they've got reserves of oil. So that sort of thing, you sort of get that double or triple dip with an equity. And ultimately equities seem to be uh, yeah, it's a fair question. Why do we spend a lot of time on equities? Because equities are huge, a huge part of the market. It's been more difficult to invest in other types of asset classes like bonds and commodities. That's less so the case. But I think the biggest argument for equities is that an equity play can be a commodity play. It can be a bond play. We can use ETFs to get bond exposure. Um, so yeah, you're absolutely right. Investments is a broad field, and we really do tend to focus more on the equity piece of it, particularly early on. But if I had my say, our major, for instance, for the undergraduate finance major, would have a fixed income securities class in it because that's a huge market. It also would have a valuation class in it. So while we spend a little bit of time on valuation, you can spend a whole semester on it and really get into the nitty gritty details of it. But yeah, fair question. The only answer I have for you though is not terribly satisfactory. I think. Huh?
No, it's fine. I was just wondering what you thought about that because I do understand like the hardest one to interpret is definitely equity because fixed income can be pretty straightforward, but it is like a huge, from my experience, it's a big part of portfolio management and planning for an
Yeah.
individual.
Oh, it is. You're absolutely right. And by the way, fixed income is no. You get into some of the theory behind that stuff and start digging a little deeper into duration. That gets pretty mathematically intensive. As does you look at anything in the derivative setting. Derivatives should be a piece of our portfolio too. And again, by holding equities, we're actually getting we could be getting a currency play, we could be getting commodity play, we could be getting a derivatives play, depending upon the securities that we own. So we are getting some of that exposure, if only indirectly. We can even get an international exposure, even if we just own domestic stocks, because so many of our large domestic stocks are multinational corporations, and they have that exposure to other markets as well. So I guess that's the main reason, is that you buy an equity and you're actually getting so much more than just that equity. Other questions or comments? So let me keep going on this efficient frontier. I've pretty much said what was on this slide here. We've looked at this idea already last week when we looked at that spreadsheet, and I did it kind of in a live setting. This is a correlation of 1, right? We had that linear relation. The moment the correlation drops below 1 is when we start getting these nonlinear outcomes. And so correlation of 0, the nice thing about this is that we've shifted up to the northwest. And not only have we created portfolios that dominate the individual portfolios from when they had a correlation of 1, but we've actually created a portfolio that has a lower risk than either of the two individual assets by themselves. So we can actually get to levels of risk that are considerably lower than the original two assets were. And then, of course, the holy grail here, the correlation of -1, we actually get to a 0 risk. So this, in fact, some of our theory uses this feature, even though it's practically not possible or very unlikely. If we need to kind of estimate a risk-free, we can actually do it either with a real risk-free, or we can create this portfolio that has 0 risk because the assets have a -1 correlation with each other. More than likely, we're going to be back here in this realm. We're not going to get out here. That's extremely unlikely. But you get the general idea. This just gives you that opportunity to play around with this in a live spreadsheet. And this last bit here, here's how we might combine not just 2 assets or 2 portfolios, but let's add a 3rd portfolio to this whole thing. So here we have U.S. bonds, we have foreign stocks, and we have U.S. stocks. And so let's see, the U.S. bonds right here, let me change the color of this, right here. And then foreign stocks out here. So higher risk, higher return. And then we have U.S. bonds and U.S. stocks. That is this line right here. This one and this one again. So here are this is our bonds, U.S. bonds. And here's our U.S. stocks. And this would be our foreign stocks. All right. So those are the 3 individual assets. Now, remember, everything is just pairwise. So we have this reddish colored line, which is the U.S. bonds to foreign stocks. We have this brown line, which is the U.S. stocks to U.S. bonds. And then we have this kind of teal colored line, which is U.S. stocks to foreign stocks. When we put all of this together, into a portfolio, we can end up, notice that, well, before I go there, notice this teal line looks like it's, pushing pretty far out to the northwest. Now this part, change colors again here. This portion of this line is dominated by this line. So we can forget about that piece. We can forget about this piece. We can forget about this piece. And we can even forget about this piece right here. Those are all dominated. So we've kind of got this, again, color change. Maybe this will help. So we've kind of got this, if I take this blue line, we've got down to there, and then down to here, and then down to here. But what that doesn't capture is all three of them together. So when I put all three of them in the same portfolio, this blue line only represents a 2-asset portfolio, or two of these items in a portfolio. But if I put all three of them into a portfolio, I can actually push this boundary, that way. I can push this boundary further out that direction, right? I'm always trying to get out to the northwest. So when I do that, I'm able to create this new, most efficient frontier that goes from here all the way up to here. And let me get rid of this part down here because I shouldn't have drawn that in. It stops right there at the minimum variance portfolio. There's my MVP for the 3-asset portfolio. So by adding foreign stocks, I've been able to push that frontier out to the northwest. In other words, I've got new portfolios I can create that first order dominate the old portfolios where I just had U.S. stocks and U.S. bonds. Or even if I had U.S. bonds and foreign stocks, I can still dominate that. So the more uncorrelated assets I add, the further it pushes things out to that northwest direction. This is all done. You can run the math on it. It's, you can use matrix algebra to kind of speed things up. But if you do it one by one, you say, well, let me start off with, 99% of asset A and 0.5% of B and 0.5% of C, and then keep shifting it out. Basically, you're going to get a whole bunch of dots, but ultimately you're going to end up with this orange line being the furthest to the northwest, and that becomes our Markowitz efficient frontier. Okay. That really is chapter 11. One last thing before we move on. When I'm doing that 3-asset portfolio, here's what happens to the return on the portfolio. Again, it's simply a linear combination. It is the weight on the foreign stocks times the return on the foreign stocks. It's the weight on the U.S. stocks times the return on the U.S. stocks. It's the weight on the bonds times the return on the bonds. Add those suckers together, I have the return on the 3-asset portfolio. When I calculate the standard deviation, this is where things get ugly. I still have those first primary terms, the weight on the foreign stocks squared times the variance of the return on the foreign stocks. Then on the U.S. stocks, the weight of that squared times the variance on that stock portfolio. And then on the bonds, the weight squared times the variance. Now, instead of just having one interaction term, I have to think about, well, I've got U.S. bonds to U.S. stocks. I've got U.S. stocks to foreign stocks, and then I've got U.S. bonds to foreign stocks. So I've got three correlations I have to deal with. So that's why I have these three terms here. And notice that there's always that 2 out front. And the weight of this last term is the weight of the U.S. stocks, weight of the U.S. bonds, standard deviation of U.S. stocks, standard deviation of U.S. bonds, and then the correlation between those two. And likewise, here was this one is foreign bonds or foreign stocks and U.S. bonds, and then this first one is foreign stocks and U.S. stocks. So here I actually have 6 terms in that variance of the portfolio calculation. So it gets a little ugly. Now, again, they give you an example. If the assets are all uncorrelated, in other words, if those correlations are 0, those last 3 terms go away, which means that lowers our variance of the portfolio by a lot, by a whole lot. And even if they're not totally 0, if they're relatively small, low positive numbers, that still makes the variance of that portfolio considerably smaller. But that's about it for chapter 11. Questions before we move on to 12?
So I've heard advice that goes something along the lines of just buy the S&P 500 and forget about it.
Yep.
But so what we've talked about just now, is there a reason to go past the 20 security number, or is that just kind of holding back your potential return?
I would argue that I'd want to go past 20. Yeah. Here's the other reason to go past 20 is that these variances that we've been talking about and these correlations that we've been talking about, theory assumes that they are constant over time. In reality, they are not constant over time. So I might have a very conservative looking portfolio whose correlations go up when times get bad. And that's exactly when I don't want them to go up. So 20 might give you a little protection, but I'd argue, hey, I'd rather actually have 100 or 1,000 securities in that portfolio. That might give me a better chance that not all of those correlations between those pairwise correlations, remember, that not all of those are going to go up in bad times. So I think that would be the strongest argument I could make for why you'd want to have more rather than less. The other piece of it is that, remember, these numbers that you're getting out of here. For instance, when we go back to this graph that we looked at, hang on a second. Here it is. This graph. This was done with thousands of stocks. So if I go to 20 here, and I say, well, hey, I'm willing to accept that. Well, that's the average of a whole bunch of portfolios of 20. Well, some of those portfolios of 20 might have been up here or up here or up here. Some were maybe even down here. But the point is that I'm worried I might pick the ones that are up here and not know it. So I would much prefer to be well over this direction as opposed to trying to get the bare minimum. And really, is there any reason to just limit it to 20 anyway? I mean, our commission structures are such that we can buy hundreds of stocks individually, even if we wanted to. But even if we were a little worried about that, let's buy an ETF. ETFs are really low cost, down in the fractions of a percent for an S&P 500 ETF, the Spider. I think it has like a management fee of about 0.1%. It's just astoundingly low. So I'd much rather say, okay, let's not take any risk here and expand that portfolio. Does that help, Reed?
Yeah, definitely.
All right. Sure. Any other questions or comments? Let's get started on 12. It's about 7:46 right here. So let's get started on 12. If we find a good stopping point, we'll stop and take a break sometime around 8-ish, thereabouts. Doesn't have to be exactly. Okay. One of the things they open up this chapter with is this idea that not all news and announcements are news and announcements that are going to affect stock prices. And this can be a little tricky, right? Because, what kind of news do we want to think about? I don't know. The Russian-Ukrainian war. We all know the war is going on, so that's not news. We all know that the Russians are trying to take some land away, that there's some risk that they shut down the gas pipeline to Germany, right? So we have already built in some expectation that come wintertime, they're going to cut the Germans off entirely to try to get the Germans to flip and turn against the Ukrainians and force them to surrender and let the Russians have some land, right? So that part of that is already known. Now, let's go fast forward into when things start getting cold, and let's say that Putin decides to, okay, we're shutting down the pipeline. Actually, I heard something about he'd already cut it off entirely. Is that relatively recent? Anybody hear that same thing? I wasn't watching real closely, but no. Okay, let's fast forward into late November. Things are getting really chilly in Germany, and Putin says, all right, no more gas for you guys, shutting off the pipeline entirely. Well, I'd already built into my expectations that there was a good chance that he was going to do that. So there is a piece of that news that, okay, it's actually realized. Instead of being an 80% probable event, it's now 100% because he did it. But that's really what this whole thing is talking about. It's the idea that, or something more mundane like earnings announcements. So I've got various companies, their earnings announcements are coming up. They're trying to set expectations, so the company is giving guidance, right? They're trying to lead us to the number that they think. They may not even know exactly the number, what it is at some point, but they're trying to lead us to the number that they expect to get. And then when they actually announce, ooh, that number is a little higher than what they expected and what they led us to believe to expect. So that's a positive piece of news, but it's not a huge positive piece of news because we already expected it was going to be $5. It turned out to be $5.25. Here's one that actually is a big surprise. Back when we looked at the employment numbers, the new jobs created, right? Last week, those numbers came out. Instead of being, what was it, supposed to be around 250,000 jobs, it turned out to be over 500,000 jobs. That was a huge surprise. So that surprise piece is the only piece that you see the market reacting to. The 250,000 was already baked in. So it's only that additional 250,000 that was a surprise to us. Now, had the jobs report come out and only been 125,000 instead of 250,000, there would have been a negative surprise of about 125,000 jobs. But that's really what they're, especially down here. You look at, we've got an announcement, right? But that announcement is composed of two things. One of them is something that we already expected to happen. That means we've already baked it into the price. And it's only this surprise piece that really matters to me. It's the surprise piece of news that is going to move the market price. If I have, a expected earnings of $5 and the company meets it exactly, no surprise, price shouldn't move much. Even there, you know that the market's probably only 90% sure. So that extra 10%, now that we actually realize it, maybe they'll still move the price a little bit. But you get the idea. And then they start talking about this concept of systematic versus unsystematic risk. We have all kinds of names for this. So, when you start thinking about vocab for this chapter, systematic risk, market risk, priced risk, non-diversifiable risk, those are all synonyms. Then the opposite side of it, one minus this systematic market priced non-diversifiable risk, is the unsystematic risk, or the unique risk, or the firm-specific risk, or the idiosyncratic risk, or the diversifiable risk. You get the idea. We've got tons of names. They all mean exactly the same thing. And this final formula down here, systematic risk plus unsystematic risk equals total risk. So when we're talking about a single company, it has a total risk of some amount, and that's going to be stated in standard deviation terms. But there are two components to that risk. One of them we term systematic risk, and the other we term unsystematic risk. Wait a minute. Where did I go? Okay, here we go. The idea that this diversification and risk, the idea that when we diversify, we are not putting all of our eggs in one basket. We diversify by having many baskets of eggs so that if we drop one, it doesn't crack all of the eggs that we have. That's related to this unsystematic risk. And as long as the unsystematic risk is not related to the unsystematic risk of other companies, in other words, I mentioned the term IID, independent and identically distributed. We talked about that, I think, in the Efficient Markets chapter, chapter 7. As long as those non-systematic or unsystematic components are uncorrelated with the unsystematic components in other companies, they just cancel out. They have a mean zero. They disappear. They diversify away. What's left is what we can't get rid of. And what's left, the reason that we can't get rid of it is why we get paid to take it. My preference for this term is that we call it priced risk, because that's actually more descriptive of what this systematic or this market risk really is, this non-diversifiable risk. It's priced. And by priced, what I mean is that we get something for taking it. If we take a whole bunch of unsystematic risk, we get nothing for taking that. But if we take a bunch of priced or systematic risk, we get paid. That's the good risk. That's the risk that we're looking to take on. That risk is basically embodied in this idea of beta, the beta coefficient. And you all have calculated that, or you're very close to calculating that value. Basically you're running at that regression, regressing the returns of the security and the returns of the market. By the way, I should mention there are a couple of questions that Karat SPX variable. For some reason, Yahoo Finance no longer, they've deprecated their historical time series on that. That used to be, it is still a ticker for the S&P 500 index. I don't know why they don't have historical returns. You could either use the spider, you could use the IVV, which is another ETF. You could also use Karat, what is it, GSPC, I think. Is that correct?
Yeah, I think so. That's one I used.
Is it? Okay, thanks, Katie. I remember looking that up, and I think so that GSPC, Karat GSPC, that will get you a historical market return for the S&P 500. I don't know why they stopped doing it. You can bring it up, and it shows that that's the S&P 500 index, but there's no historical time series on it. All right. So this idea of beta as the representation of the amount of systematic risk. Now, we're not quite at how beta does this. And in fact, this chapter just scratches the surface. I spent an entire semester on learning. A large part of the semester was going over CAPM and understanding how to derive CAPM from fundamentals. We did some other things in that semester. It was an asset pricing semester, but a large part of it was spent learning about CAPM from a calculus perspective, from a really, really heavy duty math perspective. So a lot of this is hand waving, right? So don't be too surprised. There's a lot of work underneath what you're seeing, what's being presented to you. This table actually is pretty helpful. You have your kitty up there, Reed. That's cool. So when, pardon?
He wants to see what you're doing.
Well, good. He's welcome to come in and chat. I've got a calico over here somewhere. I don't know where she is, but so when we calculate these betas, as you're all finding out, we're not always getting the same numbers. If we look at any company, here we've got ExxonMobil. We've got MarketWatch came up with a beta of 0.91 and Yahoo has 0.68. Let's look at Tesla. MarketWatch has 1.32, Yahoo has 0.55. Pretty big difference there, right? I mean, that's going to make a huge difference in the cost of equity capital. That's going to make a huge difference in what I value Tesla at. So these things are, when I'm calculating betas, theoretically, the beta should be the same beta. But when I actually implement this thing, when I move from theoretical to an empirical implementation, I use what's called the market model, which is what you all are actually using. And then things like frequency and span start to matter. And I find I get wildly different numbers. And you'll also notice that you get different R-squareds, you get different T-stats, you get different P-values, telling you that these things may or may not have much statistical significance. So it's an important thing to keep in mind here is that not every source is going to have the same beta. It could be because they used a different span. Could be that they used monthly instead of quarterly or quarterly instead of weekly. but you get the idea. Be very careful when you calculate your betas. The beta of a portfolio actually turns out to be as easy to deal with as the expected return of a portfolio. It is simply the market value weighted linear combination of the of the individual betas. And so, for example, let's say we had a beta of 0.86 and 0.97, equal amount of money in each of these stocks. So the beta of the portfolio would be 0.5 times the beta on Starbucks and 0.5 times the beta on Nike, or a pardon me, portfolio beta of 0.915. And actually, given that my voice is giving out here and I don't have a glass of water in front of me, and it's 8:02, this is probably a good time to take a short break. And how about we looked at how to calculate a portfolio beta, and it's simply the market value weighted linear combination of the individual security betas. So that piece of it is pretty easy. Now, what we're going to be looking at here is really kind of the heart of why we should expect beta to be a reasonable proxy for the priced amount of risk. So the setup here is, let's start with an asset A, and that asset has a 16% return, and we've calculated the beta for it, and it has a 1.6 beta. The risk-free rate is 4%, and of course that has a beta of 0 by definition. All right, so if we take various combinations of this risky beta A, or excuse me, this risky asset A and the risk-free rate, we get something like shown on this table. So if we have 100% of our money in the risk-free and 0 in asset A, we have a return of 4%, and that has a portfolio beta of 0. And on up to here, we have 100% in the risky asset, 0 in the risk-free, and that gives us a beta of 1.6. We can actually borrow and increase our investment in A by 50%. So we have 100, all of our money, plus we borrow half again as much, and we invest all of that in A, and we can get 22% return and a beta of, let me get over here, 2.4. So we're going to take all of this and this data here, and we're going to plot it on a handy-dandy graph. So when we do that, notice that down here we've changed the x-axis. It used to be standard deviation. And remember, that's total risk, right? That's the systematic and the unsystematic risk. Here, we're just plotting the systematic risk. We're just plotting that priced risk. So we've changed that axis. This axis remains the same, so it's expected return. All right, so with a beta of 0, our risk-free plot's right here. With a beta of 1.6, our risky asset A plot's right here. And then, you know, the 50-50 blend, 25 in the stock, 75 in the risk-free. Here's a 75 in the stock, 25 in the risk-free. Here's 125 in the stock and a short position of 25% in the risk-free. Here's the 150, and so on. It all plots out on this line. The reason this is linear, remember when we plotted a bond and a stock, or a U.S. stock with a foreign stock, we get that nonlinear thing going on? Reason this is linear is that there is 0 correlation with the risk-free asset. So that's always going to plot linearly. Now, the other thing we can do is we can get the rise over the run. Okay, and just to keep it simple, let's make the rise the difference between the return on the risky asset and the return on the risk-free, which is also known as the risk premium. And now for even more points, what's the other term that we used back, I think it was in chapter 1. We had abnormal returns and we had, should have this on a poll, excess returns, right? So excess returns and risk premium are the same thing. So we're just basically, the numerator is simply a excess return. The denominator then would be beta A minus beta on the risk-free, which is 0. So it just boils down to beta A. So when we do that math, we've got 16% minus 4% over 1.6, and we get a 7.5%. Remember, I always like to think of, I always like to explicitly write in here that denominator. So what this is really saying to us is that for 1 unit of beta risk, 1 unit of priced risk, we are getting 7.5% in terms of a risk premium. Okay? Everybody good with where all of this came from? Okay, let's go on to this piece of it. And actually, this just duplicates what I talked about. It shows the rise over the run. And I apologize. Like I said, I thought this was all taken care of when I had replaced the formulas with images. And I look at this and it's still messy. Don't know what happened there, but I didn't have time to switch it around again. But there are the actual operators in there. So that's our reward to risk, 7.5% per unit of beta risk. Now, let's add a second asset. In fact, let's not add first. Let's look at that second asset by itself first, and then we'll put the two together. So we've got a second asset, asset B, and it has a expected return of 12% and a beta of 1.2. A has a higher expected return. B has a lower systematic risk. So at the moment, it's not entirely clear that one dominates the other. But let's plot this thing out and see what we get. Here's our table again, where we have 0% in the asset and 100 in the risk-free. There's our 4% return, beta of 0, all the way down to 150% in the risky asset and negative 50 in the risk-free, and that gives us a beta on that portfolio of 1.8. If we plot that out, again, note that this is in beta. This x-axis is in beta. And here is asset B. Here is the risk-free. And we do the rise over the run, risk premium over the systematic measure of risk. And in this case, we get 6.67% per unit of beta risk. All right, now we'll put them together. Now it's pretty clear, right? Nobody wants asset B. Everybody wants asset A. And that doesn't matter how much risk I want, right? Let's say I only want 1 beta's worth of risk. So I'm down here at beta equals 1. There's the return I get from asset B. There's the return I get from asset A. So no matter where I am on the risk scale, I still want asset A because it has a higher rise over run than does asset B. All right. Now, what do you think is going to happen to these two securities in the marketplace? Let's say we all see this. What do we do?
You'll buy asset A.
Right. And if we have any of asset B, we sell asset B. Or maybe if we can short, we actually short asset B. So that drives the price of A up, drives the price of B down. Let me give you a little bit of a, I forget whether we've talked about Arrow-Debreu securities. I think we did, I did mention those, but let me go back and let's talk again about Arrow-Debreu securities. I think I've got that right. So Arrow and Debreu are a couple of researchers from back in the past century. They came up with this kind of basic concept about very simplistic securities. So we have a security that we've got two time periods, time 0, time 1, world begins at 0, world ends at 1. And we have a security that has a payoff of $1 at the end of time. And we have a price for that security of some amount at the beginning. And let's say that it's 90 cents. Okay. So the 10 cent is our return. And so that's 10 cents on 90 cents, a little more than a 10% return. Whatever that turns out, 0.1 over 0.9. That's our return on that security. Now, as let's say instead of 90 cents, let's say the return on that security was 80 cents. Now I have a 20% return or 20 cent gain on an 80 cent investment. So instead of just being a little over 10%, now it's actually right at about 25%. So the lower the price, the higher the percentage return. The higher the price, the lower the percentage return. All right. So when I think about these Arrow-Debreu securities, this helps me to understand what's going on in that marketplace with asset A and asset B, right? Because asset A had a return of 7.5% for each unit of beta risk. Asset B had a return of 6.67% for each unit of beta risk. And what we said was that everybody's going to buy A, which drives up the price. Greater demand drives up the price. So if A started out here at 80 cents, we're driving it up to 85. We're driving it up to 90. You get the idea. Everybody's selling B if they own it, or maybe even shorting it if we had the ability to short. So that's driving down. So the price of B is actually going from 90 cents down to 85 and so on. You get the idea there. But the point is that as I drive up the price of A, that puts downward pressure on the percent return I get, right? Because in the Arrow-Debreu world, my dollars that I get at the end of the world is always 1. So as I drive up the price, I lower the return. As I drive down the price of B because of all the selling, I drive up the return. So at some point, this 6.67 goes to 6.75. The 7.5 goes to 7.2. Eventually, they get down to the point where they both have a similar rate of return per unit of beta risk. Mind you, this is still on a per unit of beta setting. And then then my world is okay. Now I'm indifferent between A and B. And in fact, to the extent that A and B are uncorrelated with one another, I'd actually hold both of them. Okay, so thinking about this in that Arrow-Debreu setting helps me to understand how driving up the price is actually going to reduce the expected return, and driving down the price is going to increase the expected return and drive these guys back to some sort of equilibrium. That's what I'm trying to get at, some sort of equilibrium. Does that make some extra sense, I hope? Okay, so eventually my goal here is to have a single line that they both fall right on that line. Now I have this. Oh, go ahead.
Also, agree with the statement that you would potentially pick asset B depending on where the market is. Like if you're going into a recessionary period, the higher the beta, the more it's gonna drop. So in some circumstances, you want a lower beta.
Yes, but here's the key. I'd actually have some combination of A and B, and if I was worried about my returns or I was risk averse, I would increase my holdings in the risk-free and decrease my holdings in both A and B. And then I could shift myself back down this direction to a lower beta on my portfolio. So I wouldn't shift between A and B as much as I would shift between the A and B portfolio and the risk-free. In fact, that's where we're headed, actually. That's exactly where we're headed. Our risky portfolio, theoretically, is the same for all of us. And it's how much of that risky portfolio we hold as a percent of our total portfolio relative to the risk-free. Does that help, Vince?
Yeah, I was just wondering.
Yeah. No, you're on the right track. It's just that it's not between the two riskies. It's between the risky and the risk-free. So as we do this, so here's here's where these two guys, those ratios become equal. Whatever it is, it may not stay at 7.5 or at 6.67, but they meet in the middle somewhere. We don't care where, but they have to meet there. So the reward to risk becomes the same for each one. Now, here's a situation where not only do we have asset A and B, but we also have C and D. And it turns out that there's this temporary disequilibrium in C and D. C is getting more return than it should. It should actually be down here on the line. And D is actually getting less return than it should. It should actually be up here. So let's see, something that's getting more return, that's something I want to own. So I'm going to start buying the heck out of that sucker. What's that going to do? That's going to drive up the price, as we all do that. That's going to drive down that return. That's going to push C down till it hits the line. In equilibrium, it's going to stop there. Same thing, reverse is true with D, right? We're going to be selling D because it's not getting as much return as it should. It's going to drive down the price, which, remember, in that Arrow-Debreu world means I get more return. And it's going to drive it back up to this line. When that happens, I stop my buy, or I stop my selling. So now there's some nitty-gritty details in here that basically we're going to wave our hands at, but ultimately no asset actually ever gets off the line according to theory. There's always slight adjustments that we all make because we all see these changes. Well, yeah, right. That's all theory. That's all assumptions. But you get the idea. I think this holds enough water from a very intuitive sense that you get the idea that basically the risk to reward ratio, this thing right here, it's the same for every single security. Now, here's our kind of our final run into the capital asset pricing model, or actually what you all are using is what's known not as the CAPM. Strictly speaking, it's called the market model, is what we all call it. Most people out in the practical world call it CAPM. But strictly speaking, what we're actually estimating is the market model, because we're not using expected returns, we're using historical and realized returns. That's what differentiates the market model from the true CAPM. But we've got this thing we can call the security market line, the SML. Remember, it's going to be in the same setting: beta on the x-axis, expected return on the y-axis. And what we're looking for here is that for the market portfolio, this risk premium over beta is actually going to equal this. And since we can always, know that the 1 is down there, we can actually rewrite it just like that. And finally, if we can write things like that, sorry. All right. We do a little bit of rearranging of our terms, and we end up with that. So essentially, I'm not going to go through the algebra, but what we've done is we've taken this equality, which we just proved was truth, right? The expected return on of the security I minus the risk-free rate divided by beta 1, that has to have the same slope as the market portfolio. And now I'm doing a little rearranging, and I'm isolating the expected return on security I over here on the left-hand side. And I have what we all know as CAPM. Now, the reason I said that what you all are using is actually called the market model is that in our implementation, we're actually looking at realized returns, not expected returns. So what you're actually calculating is R sub I historical and R sub M historically, as well as the risk-free rate and the beta. And that's CAPM. In a very, very hand-waving, like I said, we probably spent a third of a semester going over the derivation of CAPM and how it was actually originally developed. There's a lot behind this. You may look at this and say, God, why did it take so long to come up with this? Well, believe me, if you look at the full derivation, you will understand. It's very messy. So with that, let me jump over to here. This line right here has a special name. And that special name is the security market line, or the SML. That is the line that every security, no matter what its risk, will fall on. It will have that same reward to risk ratio that every other security has, that the market has. And that will be this. One other way to get my beta is instead of running a regression, which actually I strongly recommend that you do run the regression because you get a lot of other nice stats out of that. You get your R squared, you get your T stats, your P values. But if you really just want a quick and dirty, what's the beta? Well, if you know what the correlation between the security and the market is, and you know the standard deviation of the security, and you know the standard deviation of the market, this formula will give you beta. So just another way to get to beta, other than having to use OLS. But that's how OLS is getting that effectively. And then the authors go through how to actually calculate these things. You all are doing this on your own, so I don't see the real value in walking through this. If you want to go back through it, you certainly can. If you have questions, just let me know. But we've got various returns for the security. We've got returns for the market. We've got deviations from the mean. We square those. So basically, we're getting variances, then standard deviations. We're getting a covariance, a correlation, then they're just calculating a beta using that correlation times sigma I over sigma m. So nothing very fancy there. Likewise, here, what they're doing is saying, you can do that same thing in a spreadsheet using a couple of spreadsheet functions, correl, average, standard deviation. And let's see, where else do I want to go with this? If we want to look at this from a graphical sense, from a graphical perspective, you all remember that ordinary least squares is if you've got a bunch of observations where we've got a x, so this is our x, that's our market return. This is our y, y, and that would be our stock returns. So we can plot them out. And here we are. We've got 5 stock returns. And what is it that OLS line gives us? What's the fit? What's the criteria for fitting that line? Anybody remember?
It has the same return or same beta.
No. Let me rephrase the question. This doesn't have to be returns. This could be any series. If I'm fitting a ordinary least squares line through here, what's my criteria for the best fit line for that OLS? A regression line is what I'm fitting. What criteria is used to fit that line? Do I just kind of go, maybe like that, maybe like this?
Is it R squared?
R squared's getting at it, but that's not the fit criteria. I'm minimizing something, if that rings any bells.
Outliers.
Yeah, to some degree, but how do I do that?
I do not know.
Anybody else? Dredge up those fond memories of econometrics. Ah, yes. I wound up getting a neck ache that lasted for about 5 years studying for my econometrics minor exam at Arizona. Oh my God. Talk about a literal and figurative pain in the neck. What are we doing? All we're doing here is, notice this line right here. We're minimizing the squared deviation from the line. So we're taking each of these, we're getting how far, in a vertical sense, that these things deviate from this line. We're squaring that distance. So it doesn't matter whether it's above or below. We're adding it up. And whichever line, whether it's this one, which actually it turns out it is, or we could adjust it a little bit like this and go, well, does that give us a better fit? Nope. some of those squared errors is a little higher. So I'm going back to this first line. I'm going back to this line right here. So it's minimizing the sum of the squared errors. So I'm getting the best fit by doing that. But this is basically our line, and we're getting that slope. That slope is our beta. All right. And of course, we can calculate some nice things like R-squareds, and we can get our t-stats on the slope. If we get a slope that is, more or less like this, might look like it's upward sloping a bit, but if we calculate our t-stat and the t-stat is 0.5 or something, well, it's actually pretty much horizontal. But that just gives you a visual, a graphical version of that OLS line and how we actually get beta. And then again, here's what you all have actually done in many cases. So you've run the from the data analysis pack, you've run the regression line, and so you've got a adjusted R-squared. You don't want to use the R-squared, right? You always want to use the adjusted R-squared, because adjusting the R-squared takes account of, there's basically, when I keep adding right-hand side variables, I'm dropping my R-squared is by construction going to go down, even if those variables have zero to do with the left-hand side variable. So I always want to make that adjustment, and so I'm always using the adjusted R-squared. Another important thing to keep in mind is that I want to look at this t-stat here. And the higher the number on the t-stat, the better. Another way to look at the t-stat is to use the p-value. Oops. And there, the p-value, I'm looking for a low number, right? I'm looking for ideally something under 0.1, or even better yet, under 0.05, or even better than that, under 0.01. So the 0.1 is the 10% confidence interval. 0.05 is 5%. So in other words, 95% of the time, it's not horizontal. 5% of the time, it could be. So this gives me a pretty good confidence interval. But here I'm looking at our beta. It says it's 0.9. I don't have a great p-value on this one, so I'm not terribly confident of it, even though my R-squared, my adjusted R-squared, is pretty decent. Obviously, this is probably driven because I have so few observations in this particular one. Pardon me. If I upped my observations to 25 or 30, I'd probably be fine. All right. Why do betas vary? Well, we talked about that before. It's, to me, the key thing is span and frequency. How many observations within the span? It's always a question of span and frequency. I can increase my frequency, get many more observations, maybe even drive up my R-squared, maybe even drive up my t-values if I have enough observations, and pretend that I have a statistical relationship or relation. And indeed, I won't if my span is only a month, but I'm using second by second data. That's ridiculous. So I'm coming up with some compromise. I want a reasonably long span. Ideally, I'd like the span to go across the entire business cycle. And we look at, the last real downturn we had was the financial crisis. That was 2008, long time ago. So it can be difficult to do that in today's world. The only good reason, if we have a recession, boy, then we've got a business cycle. I don't want a recession just for that reason, though. But you get the idea. Ideally, that's what we're after. In the real world, if we go out 4 or 5 years, we probably get enough variation in the market that we can get some reasonable sense of what's going on with these securities vis-a-vis the market. Then this last part, there's been a lot of work done since CAPM was developed half a century ago. And that work has predominantly been in finding other factors. So CAPM is a single factor model. Basically, it says that the returns of a security are related to the returns on the market, which makes reasonable sense. But when you start looking at, sorry, I skipped over something here. I'll come back to that since I'm on this trail. When you start looking at some of the data, we find some other characteristics that were pretty strongly visible in the data. So back in 1993, Gene Fama and Ken French came up with a couple of other factors. They added 2 factors, in fact. They added a factor that accounts for the size, or rather, more strictly speaking, the market capitalization of a firm. Because what we saw in the data was that small market cap firms had a lot higher returns than high market cap firms. But beta didn't capture that. So if we got a beta of a small cap firm, it would outperform. Well, that's not right. Not if we see a consistent relation between capitalization and returns. So they argued that, well, we ought to have a factor that accounts for size. So they said, okay, we add that factor, small minus big, SMB, small minus big. And then another feature that we saw regularly in the empirical data. Remember, theory doesn't come out of nowhere. Theory comes out of looking at the historical data, looking at the empirical data, and saying, are there any patterns that we can see in this? And if there are patterns, maybe we could put them into some sort of mathematical equation and model those patterns into the future, right? So one of the other characteristics that we saw regularly in all of the empirical work leading up to the Fama-French 3-factor model, which is what this is called, Fama-French 3-factor model, was this relation between book value and market value. Now, because Fama's out of the Chicago school, they called it book to market. But because the rest of the world calls it market to book, it just one's the inverse of the other. It's just you got to reverse your thinking on it. But nevertheless, that ratio, that book to market ratio, had features too. So we saw that there were characteristics where low book to market firms, that is, firms with a high market to book, the inverse, didn't necessarily perform in the future as well as high book to market or low market to book firms, i.e., value versus growth. Or actually, I should say it the other way. The first one was growth, the second one was value. All right, so they proposed a third factor called high minus low, HML. And they said that these 2 additional factors increase the predictability of the CAPM and actually improve it considerably. So in other words, here we're looking at that R squared, right? If I had an R squared of 0.35 and I add these 2 factors, my R squared might go up to 0.5, 0.6, 0.7. So that was one of the first innovations. So now we have 2 additional factors we have to deal with. So what I want to bring to your attention is that If you just run beta and you think that you're finding alpha, you're probably not finding alpha. Not unless you account for these other two factors, at least. And remember, this was how many years ago? Almost 30 years ago. Right? There's been more work. Oh, well, here's, before I get to the more work, here are the small cap to large cap, low book to market, in other words, high market to book. I always think of it this way. Sorry, I'll rewrite it. And high book to market or low market to book. And so what we see is that as we go from high market to book, the growth firms, and we go to low market to book, the value firms, the returns go up for the small cap. And we see, let's go to the large cap, 11.46. Not quite as clear a pattern. It's certainly not monotonic like it is in the small cap. But it certainly looks like there's a trend there, especially on this last one, 14.9. And then we can see a similar trend even if we go to the fourth quintile, 12.6, 13.1, 14.6, 15.9, 16. You get the idea. You see a trend in this from high market to book, from growth funds or growth companies to value companies. Certainly a trend. If we go the other direction, let's pick one column and go from small cap to large cap. Well, that one there's nothing going on there. In these growth firms. But if we go to some of the others, we notice that it starts off low and it increases, not monotonically, but it increases. Here it's more clear. It's monotonic there. Here it's also monotonic. You get the idea. So these are the patterns that we all saw in the data. And this is what Fama and French then said, aha. So let's add these as two more factors that are important to to predicting the returns on a security. Now, 4 years later, along comes Mark Carhart, and he says, aha, well, there's yet a fourth factor, folks. We're not done here yet, and that fourth factor is a momentum factor. Because, again, you look at the data, we were finding a lot of empirical studies that said, there seems to be momentum in certain time frames. And there also actually seems to be some reversals in certain other time frames. So Carhart created his four-factor model. He included the two factors that Fama and French came up with and added this fourth momentum factor. Fama and French, not to be outdone, a few years later, come back with their six-factor model. And then most recently, and I haven't really checked the literature in the last 2 years, so it's very possible that this is even out of date. But Kiwei and Hugh et al., he's down at Ohio State and actually was up here, presented this paper back in about 2019 over at Case. I happened to see him present the paper. He and his co-authors came up with what they call the Q5 model. Now, the data they presented looked really damn good. I mean, it was compelling. They blew the Fama French six-factor, the Carhart, out of the water. So Q5, if I had to run a model, if I was putting real money on it, I'd be running the Q5. Again, these are all theoretical models, and it takes a little time to plow through some of the papers. There's a lot of dense theory and math in most of these papers, but it can be done, and that's going to give you a better estimate of, are you really beating the market? Really, ultimately, that's what these models are are helping us to understand, are we truly beating the market, or did we just get lucky? So Q5, for my money, that's where we are in terms of state of the art of asset pricing at this point in time. But yeah, I'm sure that'll be probably superseded by another paper in the next couple of years. So that's it for chapter 12. How are we doing time-wise? 9 o'clock. Pretty decent. Questions, comments? I think I've got a link here to the Q5 paper, should you want to take a look at it. And I'm not sure why this is still trying to load and not loading. Huh. Weird. Let me try that again. Don't know why it's not working. I'll check it again. But if you're interested, jump in there and grab it. By the way, even running the three-factor model, I think gets you a long ways towards being much better than just doing beta. It's so 1970s, if you're actually out there in the real world. Now, don't go to your boss and go, "Oh, I know a better model," but what you might do is on the side try to run the three-factor model if your boss is running the one-factor model, and go, "Oh, this one isn't going to run very well, but I'm not going to say anything." Just to get some sense of whether this is actually working out for you in the real world. And the three-factor model is easy to run. The factors are actually, Ken French keeps the factors on his website. So I think he's at Dartmouth. You just Google like Ken French, Dartmouth, three-factor model, and you get those other two factors. So it's easy to get the data. It's easy to run the model. It's just an OLS, except here instead of just one X, you've got three X's. So at the very least, you should be running something like the three-factor model. And ideally, that Q5 really does seem to add quite a bit of value. But there again, that's a order of magnitude more difficult to actually implement. Well, let's see. At 9:04, I hate to end early, but it is 9:04. You all are probably tired. I've been talking, moving around, and you've just been listening. So apologize for the long lecture. I'll try to break things up a little bit more next Thursday. Any other questions before we go?
Go ahead.
No, I was just saying I didn't have any. We're good.
Okay. Caitlin, did you have something?
Yeah, so for that acronym SMB,
Mm-hmm.
like the slide we're on, what does that stand for again?
Oh, small minus big.
Oh.
Yeah, because it's a size thing, right? And then the other one is high minus low.
Okay, thank you.
Sure. Anything else? All right. Well, keep working on that second deliverable. I will start looking probably on Thursday to see if anybody's submitted early. But if not, then I will work as much as I need to on Friday to give you feedback on that one. The first deliverable, there's no real feedback necessary. Second deliverable, I'll go through your spreadsheets in particular, but I'll look through all the other material too and give you some feedback on that Friday. Look for it. I'll be posting that in the comments, and I will give you back points if you correct those things in your final deliverable. Okay. So with that, then let's wrap things up. I will see you all on Thursday. Thank you.
Thank you.
Have a good one.
You too. Good night.